Hello, everyone, and welcome. We have a great session in store for you today. Before we begin, I'd like to first say once again that our thoughts and prayers are with everyone at this challenging time, and we hope that you are all safe and well. We'd also like to extend our gratitude to the many that have been working so hard to keep everyone safe and well, and we also hope to keep our critical supply chains intact. Thank you to all of you. By way of introduction, I'm Rodney Sullivan. I am the Executive Director of the Richard A. Mayo Center for Asset Management here at the University of Virginia Darden School of Business. And it's my pleasure to welcome you all once again for today's call. For those of you new to this series, the Mayo Center is a center of excellence here at Darden with a focus on applied academic research and education. And consistent with that mission, the purpose of this virtual seminar series is to advance the study and practice of asset management through, of course, research and education. I'd also like to thank our co-sponsor for this series, the Financial Management Association International. Let me share a few housekeeping items with all of you now. All participant microphones have been muted and videos are turned off. For those of you having questions for today's speaker, please send them via the Q&A chat box, or the Q&A box rather, located at the bottom of your screen. And we'll collect your questions throughout today's session and put as many of them as we can to our speaker following her prepared remarks. Note that you can download Maureen's slide deck from the events tab located on the Mayo Center for Asset Management website. And in the coming days, we'll post a recording of today's session on this same site for your viewing. Okay, with that, let's move on to today's program. It is my pleasure to introduce our moderator for today's program, Professor Rich Evans. Rich is a professor of business administration here at Darden. Rich, over to you. Thank you.
Rodney, thank you so much. It's my distinct pleasure to introduce our distinguished speaker today. Maureen O'Hara is the Robert W. Purcell Professor of Finance and a professor of economics at Cornell University. She holds degrees from the University of Illinois and Northwestern University and honorary doctorates from universities in Belgium, Switzerland, and Ireland. Her research focuses on issues in market microstructure, as many of our attendees know. She's been a leading light in this field for many years. She's the author of numerous journal articles, as well as a few books, and her recent research looks at how ETFs affect market stability, liquidity issues in corporate bond markets, and transaction costs in Bitcoin, issues that are all incredibly relevant. So Professor O'Hara has served as president of the American Finance Association. I take it from those background noises that she may have a dog as well. She's also served as president of the Western Finance Association, the Financial Management Association, the Society for Financial Studies, and the International Atlantic Economic Society. She was the executive editor of the Review of Financial Studies and co-editor of the Review of Asset Pricing Studies. So in addition to her academic accomplishments, she has served widely in both practice and in regulatory capacity as well. She has served and continues to serve on a number of corporate boards, including ITG, a global agency brokerage firm where she has served as chairman of the board. And she has consulted with a number of well-known companies, including Facebook, Microsoft, Merrill Lynch, Credit Suisse, and Bristol Myers Squibb. She's served in a number of regulatory advisory positions as well, including as a member of the SEC Equity Market Structure Advisory Board. So today she's presenting her paper, Innovation and Informed Trading, Evidence from Industry ETFs, with her co-authors Xiang Huang and Zhou Zhang. So Maureen, turning it over to you.
Well, thank you very much. Thank you very much. I think you've heard my Newfoundland Hudson, who was happy to join us today. Hopefully he'll be quieter and only raise questions during the question and answer period as we proceed. Let me begin by thanking Rich and Pedro and all those connected with the Darden Mayo Center. I think it's really a great outreach for universities to be trying to do this, to try and keep alive the academic side of what we do, as well as the more practical side. And so the paper I'm presenting today may kind of fit into both camps. I know you've had some great talks in this series so far, looking more at the crisis. Today, I want to start off looking at a particular aspect of ETFs, a positive aspect. Certainly during this crisis, we've seen some negative aspects emerge from ETFs, but I want to start off today by focusing on a slightly different one. This is research with two of my co-authors, Xian Yang and Wang and Joe Zhang. Xiang is in Hong Kong, and Joe works at the University of Melbourne. So kind of a global enterprise here for the three of us. And so I'm going to talk a little bit about sort of this paper that we have about a positive aspect, as I mentioned, of ETFs. And then perhaps during the question and answer, we can move to some of the perhaps more negative aspects that have emerged during the crisis. So with that in mind, let me just sort of start here with, oh, there you go. Let's begin sort of just recognizing that the rise of ETFs is important, not just because of little issues that may arise during crisis periods, but because it's actually changed the entire asset management industry. And this is, you know, obviously a group I don't need to make that case to. For a lot of people, this has been a disruptive effect. It's certainly changed the employment structure of asset management. But for individuals, it's had a lot of positive effects. A liquid, more low-cost alternative, you know, access to unavailable asset classes before. But today, I'm really interested in investigating a different aspect of these ETFs, and that's the expanded ability to hedge. And in particular, I'm going to talk about industry ETFs. And so industry ETFs were a little bit new to the party. The first one really doesn't show up until about 1999, whereas other ETFs were you know, older than that. And we don't really quite see as many of them, you know, for about another 5 years or so. But industry ETFs are big now. And we're going to focus on the role of the industry ETF as an innovation. And when we think about financial innovation, academics love to write papers on financial innovation because it helps us understand how do markets evolve. And one of the things that comes out of the literature on financial innovation is that it can that innovations that facilitate risk sharing can facilitate arbitrage trading. And that's really kind of the name of the game we're going to be looking at today. Now, the notion of ETFs hedging is in themselves not new, right? Certainly, you've always viewed futures as a way to hedge in the equities, and index ETFs have become a way to hedge the entire market risk. And we can talk a little bit about that later. There have been some issues with respect to the bigger guys in hedging. But industry ETFs are really the only effective way to hedge industry risk. And so we're going to look at what happens when you now have this new ability to do something that you couldn't do before. So to make sure that at least some of you stay until the end, let me give you two facts that are kind of fun. One is that industry ETFs are more likely to have large and short interest than either non-industry ETFs or individual stocks. I'm going to show you that these are really quite unique. And in particular, the second thing I'm going to show you is that short interest in industry ETFs is a different animal than short interest in stocks and even other ETFs. So that's what makes it fun as a researcher to look at. And it also makes it fun to understand how these are being used in the market. So what I want to look at in particular is a particular strategy. So we're looking at trying to hedge risk. And so if you think about an informed trader who has positive information, they might like to run out and buy the stock, but then they have the industry risk to worry about. So one possible approach is to do the long the stock, short the ETF strategy. And so here, the short leg is you're going to short the ETF, the industry ETF, and you're going to have bought the underlying stock that you think you have a good information on. This is a feasible strategy because in general, industry ETFs have relatively low shorting costs and certainly lower than individual stocks. So this strategy is feasible. And the question is, well, who would be likely to do it? And it seems likely that hedge funds might adopt this strategy. So what we're going to be doing here is looking at hedge fund holdings as the long leg of the strategy. And we're going to see where this takes us. So what's our general approach going to be? I'm going to construct, or my co-authors and I are going to construct, a long-short activity measure that captures simultaneous spikes in abnormal hedge fund holdings on an underlying stock and abnormal short interest in the stock's parent industry ETF. Then we're going to focus on this long-short activity prior to earnings announcements. And then we're going to look at what's been the effect on things like post-earnings announcement drift and how the inception of ETFs affect arbitrage risks. So basically what I'm looking for here is I'm going to look at whether or not looking at this measure can do some interesting things. Can it predict, right, positive earnings announcements? Can it make markets more efficient? And then at the end, for those of you who are our asset pricing crowd, I want to show you that this thing is actually quite predictive and you could make money. So usually I bring that make money part in early, so I keep people a little bit longer. So we'll see. So what are my main results going to be? Well, let me just give you a hint of where we're going. We are going to find that they facilitate informed trading. I'm going to show you really surprisingly strong results about how this simultaneous spike measure actually is really surges before positive earnings announcements. We're going to show that large ETF short interest predicts positive earnings surprises amongst underlying stocks. I am going to show you, I think, some very strong evidence that industry ETFs improve market efficiency. And at the end, as I mentioned, I'm going to show you some important asset pricing effects. I'm going to show you that actually changes in short interest combined with changes in short interest alone positively predicts ETF returns and changes in the change in net asset values. And I can make it even better if I throw in the hedge fund holdings. So that's what I'm up to when we get started. Before we do, let me stress, we are not the only people who've thought about financial innovation, done an empirical study on ETFs, or thought about short selling. And the only reason this is only on one page is that I only have 30 minutes and I could have gone on and on and on. So there's a huge literature out there. So I just want to stress we're fitting into this. And I think we have contributions to make in all three of these areas. But let me see if I can convince that. First, I want to start off and think about what do I want to know about this long the stock, short the ETF strategy. So I'm going to actually test 2.5 hypotheses. The first hypothesis is just the basic one. Does anyone actually do this? So here's the hypotheses written here. If they use the long the stock, short the ETF strategy, then there should be simultaneous spikes in hedge funds' long position on the stock and short interest in the stock parents ETF before the stock announces positive standardized unexpected earnings. So this is an empirical question. We're going to test it. There's a related question. This would only really work if the underlying stock actually had a large industry exposure, right? Now, obviously, if it's in an industry ETF, you might think that it has some industry exposure. But let's think about industries. In an industry, there are some stocks that are going to be much more important in driving that industry return than others. So the second thing we're going to be looking at is the relationship between long-short activity and positive SU more pronounced among stocks with high industry risk exposure? Then our hypothesis 2 follows from all of this. If this industry ETF helps investors trade on firm-specific information, then we expect the industry ETF to reduce the post-earnings announcement drift, or put another way, make markets more efficient. So let me show you a picture to begin with here. This is industry ETFs, and these are non-industry ETFs. This is just showing you how big is short interest. And on the left, you see the industry ETF picture. The average industry ETF short interest over our period, which runs from, our sample period runs from January 1999 through the end of December 2017, is 11.5%. So these things are heavily shorted. And that compares to non-industry ETFs where it's about 3.7, right? But notice something really interesting about this graph. Look at that little spike out there at 1. It is not unusual to find short interest in industry ETFs at like 200% or 300%, which, you know, when I first ran into that in writing this paper, I called up friends at Citadel and said, how is that even possible? And they explained to me how it could be that way. But I'm telling you, it does happen. And in fact, if you look at the 90th percentile, 95th percentile of industry ETF short interest, it turns out to be 59.4%. So these are huge short positions often in industry ETFs. So now let's go back to how I'm going to test all this. We're going to take each ETF, industry ETF, right? And what we're going to do is we're going to take every stock that's in each industry ETF and we'll create this stock ETF pair. So if an ETF has 30 stocks in it, then there'll be 30 stock ETF pairs for that particular ETF. And we'll do that for all the industry ETFs. Then we're going to define a dummy variable one if both the abnormal hedge fund holdings of the stock and the abnormal short interest of the ETF are above 80% percentile of the sample. Now, I haven't told you about all the data we use. There's tons, but go look at the paper. It takes pages to tell you all the data we do. And ultimately, we're going to run this regression. So that dummy variable I just described, where it's both high abnormal holdings of the stock and huge and high abnormal short interest, is going to be captured by this dummy LSIST, right? So we're going to look at that variable, and then we're going to we're going to run it on those variables underneath. So we create the first dummy, and then we create the second dummy. Now we're going to have that dummy positive SU is equal to 1 if the stock's standardized unexpected earnings are in the top 25% of the earnings announcement sample. So let's think about how we're doing this. The earnings announcement will come out at the end of a quarter, and we're looking at the hedge fund holdings and the abnormal stock interest before that. So we're looking at essentially something that's predictive. And let's see what it looks like. Well, here's a pretty busy picture, but the key thing is to look at the things on the left columns in red. So what you see is that that dummy on positive standardized unexpected earnings is both positive and significant. So what does that mean? It means that long short activity elevates before a positive earnings surprise, right? In the first column, we're just running the dummy on our dummy LS. And the second one tries to control for all the things you might think would affect that. Now you might sit back and say, well, all right, that's kind of neat, but maybe that's true in general. But column on the right says it isn't. Let's do the same thing. Let's look at non-hedge fund holdings in the period before and see how that loads. And so what you discover is, no, that doesn't explain it, right? It's not that everybody does this. This is essentially hedge funds are holding these things. The short interest is going up, and we're seeing that this is happening before positive earnings announcements. Now, I want to be very clear. This is true over our sample period, which I mentioned earlier, but it's not always true. And I want to be pointing out here, you can do two things with industry ETFs. You can hedge, like we've talked about here. You can also speculate. During the crisis period, which we define to be fourth quarter 06 through fourth quarter 08, this doesn't hold. So, you have to be a little careful here. But in general, these are quite strong. Over the whole sample period, it's a very strong result. Is it happening right now? Maybe not. But we're going to come back to that because I'm going to show you I can actually use that fact to help me later when I want to prove something else to you. So let's talk about hypothesis 1A. Well, is this stronger for stocks that have higher industry exposure? And the answer is yes, right? So we took all of the stocks that underlie the ETF, and we broke them into half. Those that we estimated all their industry exposure, and then those that had lower, we put in one group, those that were higher in the other, and sure enough, this effect still holds across all of them, but it's stronger for the stocks that have higher industry exposure, which is what you'd expect. Now, we've shown that this strategy appears to be being implemented. What does it do to the markets? Well, here's what we're going to do. We're going to ask, does being an ETF, an industry ETF, reduce post-earnings announcement drift? So the first thing we got to worry a little bit about is that when you put together an industry ETF, it's not totally random. It's true that everybody in it is in this industry you're after. But that doesn't mean that the stocks that aren't in that are the same as the stocks that were excluded. So we have to be a little careful. And so what I'm going to do is I'm going to actually show you several tests here to try and get at this market efficiency idea. The first one we're going to do is we're going to use a propensity matching score and match sample approach for membership differences. Yeah, never fails, does it? There we go. To try and sort this out. So what am I going to do here? I'm going to form a sample of stocks that are in industry ETFs, and I'm going to look for stocks that aren't, And then we will essentially try and test whether or not being a member of an industry ETF reduces your standardized, the PEA, the change in unexpected earnings. So here's our equation and here's our results. And the key thing here is, again, what I've put in a little box. So I'm looking here at the cumulative abnormal return. The first two columns are over days 1 through 30. And the last two columns are days 1 through 60. So it depends on how you want to look at your post-earnings announcement drift. What you see here is basically that it's negative and significant. And what does that mean? It means that member stocks of an ETF have smaller PEAD than non-member stocks for the same level of earnings surprise. So this is kind of a cool result, right? It really does show that if you're in an industry ETF, the ability to pursue this policy is making the markets more efficient. Now, I hope there are some skeptics out there. I always am when I watch paper presentations. I say, well, I don't know. Is it really due to the ETF? So here's another way we're going to look at this problem. We're going to look at long-short activity around earnings announcements in the 2-year window around the industry ETF inception, right? So the nice thing is most of these have been more modern than really old. So we take the 2-year period around, and now we're not going to create control groups and target groups from non-ETF stocks. We're going to use the ETF itself. And we're going to assign that stocks are in the member group into 2 groups, high industry exposure, and the control group now is low industry exposure. Then we're going to create a pseudo ETF to capture the period before the actual ETF got created. So we're going to look the year before this ETF was created. We use the weights on that ETF for the year before. And we'll look at how post-earnings announcement drift affected these 2 groups, the high and the low, right? And so what am I going to find? Well, I'm going to find just what I hoped for. We're going to find that in the year before the ETF inception, the industry ETF inception, post-earnings announcement drift is exactly the same for the 2 groups. But after we bring in the ETF, we get a big reduction in the high industry exposure stocks. So with that, let me turn to a third issue we're going to look at, which is arbitrage risk. And arbitrage risk is a third measure we're going to do. We're going to use an approach suggested by Wergler and his co-author, I'm not brave enough to try that name, in which we measure this extent of a stock's variation that could be hedged by substitute stocks. And so what we're going to do for each stock in an ETF, we're going to pick their 3 closest stocks out there to be substitutes. Then we'll look at a difference in difference test on a residual variance before and after the ETF inception. So what do we find? The inception of an industry ETF leads to a meaningful reduction in arbitrage risk, and it's greater for pair stocks with higher shorting costs. So what have I hoped I've shown you so far? That this long the stock, short the industry ETF strategy is one that's being used. It seems to be implemented by hedge funds. It's predictive of future abnormal positive earnings. And it seems to make the market more efficient, right? It reduces post-earnings announcement drift. It seems to be backed up by a variety of tests. But it turns out that there's actually now some other interesting implications of all of this. So one of them is that we have an interesting asset pricing implication. Remember, one of the things we're showing is that big short interest is actually good news. That's actually strange, isn't it? For all of us who've ever studied short interest, you know, short interest is usually bad news, but not when it's being used to hedge. And because of that, extreme short interest should create a temporary price impact in the IETF, right? Leading to predictable IETF returns. That is, remember, people are shorting this. So the question is, well, what does that tell us about the future? Let's find out. So what we're going to do is we're going to create a long-short portfolio based on 3 IETF monthly change in short interest portfolios. So think about it this way. We're going to look at, sort of industry ETFs that have lots of short interest. That's going to be one. Then medium short interest and low short interest. Okay. And we're going to look at Delta SIR because there tends to be a fair amount of consistency across time periods in the Delta SIR. So the way to sort of deal with that is to use changes. So we're gonna long the ETF that has the biggest change in short interest, right? The most short interest, and short the ETF that has the least short interest, right? Now think about if you did this with stocks, because people have done it with stocks. If you do this with the stocks, it turns out if you buy the stocks that are heavily shorted and sell the stocks that are not heavily shorted, you result in a negative 40 basis point return a month. So that generally hasn't proven to be a very popular investment strategy. But let me show you what's going to happen when you do it with industry ETFs, right? So here we have done these sorts here. We've got our bottom 30, our middle 30, our top 30. Remember, we're going long the top 30, short the bottom 30. And we've got just excess returns, CAPM, Family French 3, Family French and Carhartt 4. And this yields a return of 25 basis points a month. Now, again, some of you, I hope, are skeptics and they're saying, wait a minute, you're forgetting that there's all kinds of stuff connected with the arbitrage of ETFs and the creation and redemption process. So Eunice may be picking up weird things about the ETF redemption process. It's being caused by that. But we do the same thing here, and instead of using the ETF return, we look at changes in the NAV, right? So we're actually predicting, if you will, the performance on this based on the ETF NAV. And again, it's even a little bit stronger. So we don't think it has anything to do with the creation and redemption process. We think instead what it's reflecting is that the short interest, basically the huge short interest in these things creates temporary price effects. Now, those of you who went to Chicago and believe that markets are efficient, more efficient than that, let me stress, remember that chart, that table I showed you earlier? These industry ETF short positions could reflect hedging or large short, they could reflect bad news. It's not immediately apparent which one it's going to be unless you do a little work and figure out some of this hedge fund stuff. So what I'm showing you is these are temporary price effects. And but earlier I argued that, we knew the mechanism for this to work. We knew it was the hedge funds who were implementing this because we looked at their holdings simultaneously. So if return predictability is higher, if hedge funds increase contemporaneously, wouldn't that help me with this strategy that I've just defined on the ETF? And so what we're going to do is we're going to define this variable positive abnormal hedge funds holdings to be the number of underlying stocks in an ETF that have positive abnormal hedge funds holdings in a month T divided by the number of members in ETF I. So what's that mean? Suppose you're at an ETF with 30 stocks and 15 of them had abnormal hedge fund positive holdings, right? And you had another industry ETF with 30 stocks and 4 of them had abnormal hedge fund holdings. Well, we're going to measure this positive AHFT to be the number of underlying stocks. So now we're going to look at how many of the underlying stocks have this higher than normal abnormal hedge fund holdings. And now we'll run this thing. All right. So again, what are we trying to predict here? We're trying to predict the future ETF return, and we're doing this monthly. All right. And we're rebalancing monthly. So if you do this, here's what you see, kind of interesting results, right? Before, I was making 26, 28, depending upon what you wanted to look at, basis point return a month. But now that I'm using this double sort on both high and low changes in short interest ratio and high and low positive hedge fund, abnormal hedge fund holdings, my return from this little strategy, the high-low strategy, buying the high ones and selling the low ones, yields between 51 and 52%, 54 if you want to go in the middle. Basis points, not percent, basis points. So obviously kind of interesting results here that you can predict ETF returns doing this. And here's a Fama-MacBeth regression. It's not an asset pricing paper unless you have one of these. And so this allows us to control for a variety of factors that you think might matter. We have all kinds of controls. And what matters again, this is looking at, the stocks that have, and these are the effects. This is we have again, both the return on the ETF in the left-hand columns and the return on the NAV in the right-hand columns. And here you have sort of the impact of both the high SIR and the high hedge fund holdings. And sure enough, positive and significant, right? A very interesting, I think, role that this is playing. Some of you are stock level fans. I just showed you results about the predictability of the ETF return. But, maybe you say, well, what about those underlying stocks, right? What does that do? How does that get me anywhere? So we can do that too. So here's what we're going to do. This is a Fama-MacBeth regression. I didn't put all the other terms in just because it's kind of easier to look at. Remember that very first dummy variable we defined, that LS-IST dummy variable? That's the dummy variable that captured the simultaneous, we looked at, stocks that had simultaneously high short interest ratios in the parent industry ETF and high abnormal hedge fund holdings in the stock. So now what I'm going to do, I'm going to run the return of the stock, future return, see, S in month T+1, on a dummy variable that captures that abnormal spike. And sure enough, what do you see? Positive and significant, right? Makes sense that we can actually predict the underlying stocks using these variables as well. And it gets even better when you sort of look there at the effect is stronger when you say, okay, it's not just high short interest, not just high abnormal hedge funds, it's also stocks that themselves have high exposure to industry risk, definitely stronger. So I think I'm probably running short on time. So let me hit to conclusions and then we'll sure open this up. What have I tried to talk about today is the role of innovation and how industry ETFs can be a valuable innovation by facilitating the hedging risks. And one of the things we've shown here is that they enable the industry, they enable a long the stock, short the industry ETF strategy. And what have I shown you? That, as I mentioned, these are a different animal than short interest in stocks and even other ETFs. Here, if these are being used for hedging purposes, large short interest is actually good news, right? And we showed how you could actually make money off of that. It results in return predictability. It appears to be implemented by a hedge fund. It makes the market more infinitely efficient. Now, before I quit, I should mention, probably some of you are saying, well, does it work in reverse? Like if you know negative information, could you short the stock and long the industry ETF? You could. It turns out, though, that there is some predictive power there, but it's much weaker. And we attribute that mostly to the fact that the problem is once you do that, longing the industry ETF is easy, shorting all the stocks, not so much. So the costs are higher. But there is still some predictability. It's just that it looks like it's predominantly done to exploit positive information. So with that, let me close and turn this back to our moderator. And Rich, we'll go from there.
Maureen, thank you so much. That was fantastic. If there were a function like this in Zoom, I'm certain you'd receive a tremendous applause from the 350 plus participants today. So I'm sorry we can't convey that in some way. We'll have to figure that out for next time.
Well, it's my pleasure.
So we're trying to, I'm getting a lot of questions, some related very specifically to the paper, some that are broader about current market conditions. And so I'm going to try and parse them into two parts. And my apologies to participants if I don't quite phrase your question correctly. But the first set thinks about this issue, which you focus on this paper, of price discovery relative to, let's call it, transmission of volatility. Right, so you provide really interesting evidence that specifically for industry-related information, these ETFs are able to aid in price discovery. COVID-19 has led to some pretty large industry-specific price adjustments, both positive and negative. And so the question is, do you think ETFs are helping with price discovery in those industries, or are they just enhancing the ability of traders to panic with respect to those industries? So one participant specifically suggested the possibility of a run on airlines recently. So what do you think?
You know, it's an interesting question, and it's a great set of questions, and one that I've worried about in some other work that I've done as well. I think there's no question that price discovery has shifted to many of the ETFs, particularly the industry ETFs really do give you an ability to capture what's going on. And, you know, earlier when we were looking at the crisis period, right, one of the reasons that the crisis results didn't look like the others is the heavy shorting of the financial services industry in using ETFs. I mean, it just, you know, and I would imagine that, you know, I assume there's an airline ETF. I haven't looked into it, but it certainly would be a quick way to take a position. So I suspect that is not helping. You know, it's an interesting time right now because I think as we look at these ETFs, you know, look even more broadly, look at the bond ETFs, right? There's no question that the bond ETFs have struggled in the last couple of weeks. And part of the challenge is, right, we've seen big gaps between the bond ETF price and the net asset values. I mean, gaps that are 5 and 6 and 7%. And that just is not supposed to happen, right? That, you know, everything we believe about arbitrage is not supposed to happen. And so one of the challenges that we have is, you know, what's been the impact? Well, in bonds, one of the things we've seen, right, is that the ETF prices are generally the better price. The bonds are stale. But is the ETF price creating more problems, right? Do investors see the ETFs and they're like, I'm out of here? Which then puts more pressure on the underlying bond markets, which are illiquid anyway, and builds kind of more problems here. And I think we've seen some of that, and we've seen evidence of that because when the Fed stepped in what was, you know, a first ever announcement that they would support the bond market, right? It reflected the unusually fragile nature the bond market exhibited this time. And the Fed, in addition to saying they would buy bonds via BlackRock, also said they're going to buy ETFs. The Fed's never done that. And bond ETFs, not equity ETFs. So I think we're seeing both the good and the bad, right? The good is, yeah, here's the good news. You want to short airlines? Go ahead. Here's the bad. These ETFs are big and they're capturing so many effects that they can actually kind of create, I think, more challenges in the markets too.
Yeah, so when you think about those bond ETFs in particular, you know, we have seen dislocations. I think the Vanguard BND was 6% at its max. Those deviations could be incorporations of, you know, new value relevant information, right? That could be, that's the true price because we know the bonds are stale. But it could also be, as you pointed out, it could be other motivations for trade, maybe destabilizing herd behavior. So as a researcher, how do I disentangle those two, do you think?
That's a good question. You know, I think it's tricky. There's a very interesting paper that came out like 3 days ago from the Bank for International Settlements that started looking at this. And they didn't quite disentangle it, but they did a nice job. Those of you go to bis.org, you'll find it, and looking at like the effects of ETFs on bonds. I think we're all going to be trying to look at that. And I'm working on research right now with a co-author at the Fed, where I think one of the ways you begin to disentangle is you try to understand what is creating the illiquidity in the bonds. And the illiquidity in the bonds can be coming from a variety of things. And so, you know, I think we have to control for all the factors that we know lead to liquidity, and then see if the flows are related to all of this. Excuse me. Rich, can you hear me?
Yeah, yeah.
Okay.
So I think we've had several questions as well about shorting ETFs, right? So whether it's short interest or the cost to borrow, even the most, you know, liquid ETFs have jumped pretty dramatically over the past, you know, 5-6 weeks.
Right.
Now this shorting can occur through one of two mechanisms, right? We can think of a traditional prime broker, locate, borrow, but ETFs have this unique feature where authorized participants can create to lend also.
Right.
So when you think about those two mechanisms, and specifically one of the participants asked about USO and the increase in short interest in USO, I mean, when we think about market conditions, what are the different implications for shorting via those two mechanisms?
So, you know, the interesting thing, you're exactly right. The reason why you can get 200 and 300% short interest is because of the creation redemption process, right? If in a normal stock, there's only so much stock, right? Or any kind of, you know, if 98% of it is shorted, good luck trying to cover your short, right? But if you have an ETF, you can, you know, it's like the old Doritos commercial. If you like it, we'll make more, right? So, you know, they can just come up with more of this stuff. And that's what allows these industry ETFs to have these huge short positions. Now, when you look at US oil, I think, you know, all of us have been watching that with a combination of, you know, it's kind of horrifying, but you can't look away kind of thing, because, you know, US oil is different than what we've been talking about, because underlying it are futures contracts,
Yeah, right.
you know, and they never want the oil, right? So what they want to do is just roll those futures contracts. So, U.S. oil is a tricky little critter, particularly if the futures, as you sort of, well, you're nodding here, when it goes negative, I don't even know what it means. So that's a big issue here. I think one of the things that this crisis is pointing out are things that many of us have been concerned about. I am not a fan of leveraged ETFs. I think the number of people for whom a leveraged ETF makes sense is very small. And you know, one of the things, we look at US oil, but, you know, you look at some of these other commodity-based ones. There's another one that has just ceased trading, right? Because it's an ETN, not an ETF. So underneath that is a swap. Again, not the actuals. And BNP Paribas, that had written the swap, isn't willing to extend the swap. So guess what? Game over. So there's a lot of features of the ETFs that are coming into focus. And you know, where this takes us, I don't know. But having said that, I'm actually a big fan of ETFs. I think they're a really genius type of product, but this creation redemption only works if you can actually buy stuff up and redeem it. And one of the things we saw when the bond prices gap out, right? You want to buy low, sell high. So the bond prices are high, the ETF is low, you know, buy the ETF, turn it in, get the bonds. Right? And that's what Vanguard and others were like, oh, we're not doing that. And we're not giving you, they're willing to do that, but they you know, it's a real challenge, and they certainly weren't willing to give you the cash for it. So a very interesting sort of situation.
Okay, related to the short interest, and you're right, USO is a very different animal, but let's go back to something that's backed by actual underlying, right? So the question's about ETFs that have short interest greater than 100%, and whether or not that can precipitate a liquidity collapse. I always think about XRT. This is the Spider retail ETF. Now that's been over 100% for years, right? So it hasn't collapsed. But when we go from regular market conditions to what we've seen over the past 6 or 7 weeks, can short interest that high have market destabilizing effects, do you think?
That's a great question, and I suspect we'll start to see some papers written about that. I mean, you know, once you get your head around the fact that it's possible for something to have short interest above 100%, then you know, you do kind of ask yourself, well, you know, what happens? And, you know, interestingly enough, so far, these things are holding up, you know, but That's the advantage of being finance professors. That's an empirical question, and certainly one that I'm sure the Mayo Center for Asset Management will be interested in addressing.
Okay, so more questions from participants. Your paper is a great explanation of why a hedge fund or informed trader might do this. Why would a regular passive investor choose to hold an industry ETF rather than broad market? So I think I have an answer, but I'm curious what your answer would be too.
Well, I'll tell you, I think one of the things that we really have to understand now is that ETFs are active in many ways, right? They're not passive investments anymore, right? If you want to hold, the SPY or IVV or some of the gigantic big passive funds, you're holding the whole market, good luck to you, that's great. But there are over 5,000 ETFs now, and they range from, the giant passive to, ones that are based on biblical values and ones that are designed for, there was a whiskey and spirits. I mean, there are these very, very narrow ones. Now, why do they do that? Because ETFs can be active in form and they can be active in function. And so if you want to think about form, you may say, okay, why would I buy an industry ETF? Well, maybe I really think that there's alpha in that industry. That industry is undervalued, right? So, I'm buying paper products. I want the paper products ETF. I think that is undervalued. There's alpha there and I'm buying it. But you may also have a different view, which is I want to build a sort of factor portfolio, and I'm going to use ETFs as the building blocks. And in this setting, industry ETFs are perfect building blocks, right? You can view them so now you don't build your portfolio with individual stocks, you build them with individual ETFs. So that's my answer. What do you think, Rich?
I'm sure. I like it. I think that's spot on.
Well, I'm sure there are other aspects of it. I mean, the ETFs now, the days of them being giant passive investments are so not now.
Yeah. So now this, I think any seminar wouldn't be complete without a bunch of people who want to poke and prod at whether or not your return predictive regressions in particular really, could this really be implemented, right? So I got a host of questions related to that. I'm going to go one by one.
Are we out of time yet?
At any point in time, if you want to, you can accidentally turn off your laptop and I'll understand completely. But okay. So first of those, right? So one audience member suggests the cost to short industry ETFs is quite expensive. Now that's a borrow rate, right? So create to lend would be different, but at the same time, that's been my experience as well looking at that data.
Well, so actually, we did test for this, all right? So we got data on the shorting costs for all these things. Is it DCS value for market, whatever it is.
Yeah, right.
And again, we broke them up into, we ran all our tests and we used ones that, we broke them into ones that were high shorting costs and ones that were low shorting costs, right? So again, a great question, natural to think about, we did. And one of the things we find is, certainly much stronger for the ones where you have lower shorting costs, but it still holds, right? So the shorting costs are not enough to kill this thing off.
Okay, now what about the results? Are they sensitive to the premium or discount, probably more likely the discount in this case, of the industry ETF, market price relative to NAV? Does that play a role in how predictive it is?
Not really. I mean, we predicted NAV, and we're predicting the change in the NAV, right? So we didn't, I'd have to check. I have to admit, this paper I think is up to 83 pages long, and most of it is in an appendix. But I think we certainly looked at various sorts of variations on NAV and predictability, but whether we specifically looked at that, I can't remember.
Okay, I've got a few others here that, well, probably because in the interest of time, I'll forward to you. But one last one. Somebody asked, and this is purely speculative on your part, but what if we replaced industry ETFs with a bunch of levered ETFs and repeat the analysis? And I know Sean Davies has this levered ETF market predictor paper. So maybe it's something like that or different. I don't know. What do you think would happen if we put in levered ETFs?
I hate levered ETFs. So let me just say right up front that levered ETFs to me, we'll see the carnage after this goes on. I don't know what would happen. I really, I was very surprised that the SEC approved them in the first place. They are a very, very tricky product, incredibly volatile. So if you think about where we are right now, the fact that ETFs could be contributing to volatility is a little scary. That levered ETFs, I only see one direction it could go, that it would make things more volatile. And, we saw back, with the whole VIX thing, with those levered ETFs several months ago, where, they kind of, you had levered ETFs that were kind of in shambles. So, it may be, I'm sure that those of you who work in the levered ETF industry will write me an email and tell me how misguided I am, and I'll be glad to learn that. But in general, I can't imagine that would make things better.
Okay, so last of the return-related stuff. So do these results suggesting that hedge funds are informed? How do they square with hedge fund performance in general is the question.
Well, remember, we're looking at a period from January of 1999 all the way up through, the end of December 2017. Over that period, hedge funds did really well. I think that this is one of the ways that hedge funds actually do well, right? I think, one of the things we found, right, is that they have abnormal holdings of stocks that seem to have positive earnings announcements, which seem to be suggestive that they are informed, and they hedge it. So I think one of the reasons hedge funds have been successful is that they do more sophisticated strategies than we do as, less sophisticated investors. Now, do hedge funds lose money when they don't hedge or when they take big positions that they shouldn't? Absolutely. And, are they doing it now? My guess is if you looked over these 2-month period, there's so little good news that, this strategy would be more or less non-existent. But that remains to be seen.
Okay, so last kind of big picture question. So one of the important missions of Darden's Mayo Center is to advance the study and practice of asset management through research. So I think about the things that can be learned and the way both practitioners and regulators can help to be informed. When you think about the issues that have been raised over the past 6, 8, or even 12 weeks, even beyond then, about ETFs and potential added risk during periods of market stress, what questions should researchers, and there are a bunch of junior researchers that are listening in right now, what questions should they focus on? What things are really important, not just from an academic perspective, but to educate and inform practitioners and regulators?
Well, I think, every time you have one of these crises, they reveal sort of fragilities in the markets. And, right now, I think everybody is still trying to understand what caused things to gap out the way it did. I mean, one of the concerns we've always had about putting ETF, a very liquid, asset on top of an illiquid underlying is what would happen when, liquidity dried up. So certainly one of the really interesting questions is what led to that gapping? And the fact that when the Fed stepped in and said, we'll give you liquidity suggests it's a liquidity problem. But why, right? Did AP step away, right? Was there not enough capital being put into this process? I don't think we know the answers, but we should. The other thing that I've seen that I find really intriguing is, the first thing the Fed did is they stepped in to help the money markets. Well, that then led apparently to people selling out of both bond ETFs and bonds to go run to these now guaranteed settings of money markets. And so, now we've got all these moving parts and none of them are independent, right? When you choose one, move one, you move the other. So I think for younger faculty who are, looking at interesting questions, I see them everywhere, right? But I think this whole, how does this affect that is really important. there had been some thought that the money market funds had been holding bond ETFs instead of cash, right? Prior to the crisis. Was that the case? And if so, is that part of the problem when they faced redemptions? Were they the first to dump the bond ETFs, which then led more and more and more? I mean, it would be great if we can begin to get data on, you know, sort of who was trading when and where. And of course, the beauty of ETFs is we have all their data. So those are the issues that I think are front and center. And we need to be cognizant of, you know, particularly in these areas like bonds, right? And the equity ETFs have not really created a huge problem, except in one area, which is that apparently the futures liquidity has been low because everybody's hedging with the, you know, the giant passive ETF. So it's endlessly entertaining and endlessly interesting to see how all these things work together.
Maureen, thank you so much for a fascinating presentation and even more fascinating Q&A. We really appreciate it. I want to thank everybody who joined us. We will be here again, as Mark said last week, same bat time, same bat place. And our next speaker, I believe, is Lasse Pettersson. So he'll be speaking next Friday. So Maureen, thank you so much again.
My pleasure. Thank you very much. And I hope everyone stays safe. Thanks again.